This presentation is going to cover the methods used to account for investments in other company stocks as part of advanced accounting. The reporting investment in corporate equity securities, this is when you buy somebody else's stock, usually common stock. There are 4 ways that we can report this investment in other companies. One of the methods is called the cost method. You use this when you buy securities that are not widely traded, so therefore the fair value is not readily determinable. The fair value method. This method is one of the methods we will be covering along with the equity method and consolidated financials. So now let's go over what does it mean. So, depending on the degree of influence drives how you're going to record the stock in the other company, your investment in the other company's securities. Now, for the first method, we're not going to go over this very much, but this is what you do. It's actually similar to the fair value method, because what you're going to do is you're going to record the stock based on what you paid for it, and then you're going to review it periodically to see has the value gone up or down. If it's gone down, it would be treated as an impairment loss. If it's gone up, it would be an adjustment to fair value as part of other income on the financial statements. Now, the other methods, the fair value, the equity, and consolidated financials, really there's only 2 methods. One is if you own less than 20% of the stock, usually it signifies that you do not have significant influence, so therefore you can just record the cost and then adjust to market. If you own 20% or more of another company's stock, then you would use the equity method because it implies that you have significant influence. Now, if you own more than 50%, you not only use the equity method, but you also have to do consolidated financial statements. Now, what does it mean in terms of how you record transactions between the parent and the sub? Now, if you're using the fair value method, you're going to record the initial investment, and the only income you will record as part of this investment would be if you receive any dividends. That would be the only income you would get from this subsidiary. And the only adjustment to the investment account would be changes in market. Now, it used to be these changes to market for what we would consider these available for sale securities. Usually what we would do is treat this as part of other comprehensive income, but starting December 15th, we no longer will do that. And so any adjustment to fair value would go as part of other income on the financial statements pre-tax. Now, the equity method. If we're using the equity method, it means we own 20% or more of another company's stock. We're still going to record the initial investment. However, we are going to also adjust the investment account for any income or loss of the sub based on our percentage ownership, and any dividends we receive are no longer going to be income. Instead, they're going to be treated as a reduction in the investment account. Now, consolidated financials. We're going to still record the initial investment. However, we only prepare one set of financials. This is the parent, and we're going to combine their assets with ours, along with any of their liabilities, their revenues, their expenses. And we're going to treat it as if it is a single entity. Now, one other area I wanted to cover, I know they cover this in the book, is, well, what happens if you have a situation where a company owns less than 20%, which would dictate they use the fair value method. However, they have significant influence through a contractual agreement of the subsidiary. This is also known as off-balance sheet financing. Well, GAAP came out with a new ruling that says, well, I'm sorry, as if you have significant influence even though you own less than 20% of the stock, you must do consolidated financials. So these SPEs, as they're called, must be part of your consolidated financials. Now let's take a look at a little example. At the beginning of 2017, your company invested in Little Company by purchasing $500,000 of its common stock. Little Company reported a net income of $200,000 during 2017 and paid cash dividends of $50,000. By year end, your investment in Little had a fair value of $560,000. What adjustments would be made to the investment in Little account if the purchase represented 10% of the outstanding stock and there was no influence, or the purchase represented 25% of the stock and you have significant influence? So let's start with the 10%. Of course, we would still record the initial investment, which would show an increase in our investment account and a reduction in our cash. Next, at year end, we would adjust to fair market value. In this case, our investment of $500,000 is now worth $560,000. So now we have an increase of $60,000. So what we're going to do is increase our investment account by $60,000, now giving us our total fair market value of $560,000. And this is what the journal entry would look like. And this would be part of other on the income statement. Now, if we have the dividend revenue, which we did, this is going to be the only revenue from the sub that would appear on the parent's books. So it's only when you use fair value that dividends of the sub are treated as revenue on the parent's books. And this would be our journal entry. So it would be cash and dividend revenue. And again, this would be shown as part of other income on the income statement. Now, what happens if instead it represented 25% of the stock and you had influence? Well, we would still record our initial investment of $500,000. That would be done exactly the same as it was for the fair value method. But now, what is going to affect that investment account? Well, two things right now. First, we have to record our share of the sub's net income, which is, and we're going to take 25% of that because we only own 25% of it, and that will increase our investment account. And that would be treated as income on the parent's income statement. So they would show this equity investment income. Now, the next thing we would do is record the dividends, but whenever we use the equity method, dividends are not revenue. Remember that when you're doing the homework, dividends are not revenue under the equity method. Instead, they're treated as a reduction of the investment account. And that gives us a new adjusted total. Now, one thing I'm going to cover in this presentation, one more thing, and that is what happens if the investment balance goes to zero under the equity method. Well, the rule is when accumulated losses incurred and dividends paid by the investee reduce the investment account to zero, no further losses can be accrued. A temporary decline is ignored. Once the original cost of the investment has been eliminated, no additional losses can accrue to the investor, which means your investment account cannot go below zero. If there is future equity income, it will be offset by these losses prior to recording equity income by the parent. So you would still keep track of the losses, you just wouldn't be able to record them. So let's take a look at a little example. Okay, in this example, Company A purchased 40% of Company B stock for $500,000 on June 1st. Company B reported the following. In 2016, Company B had $150,000 in net income and paid $20,000 in dividends, and then from that point on proceeded to have major losses. Well, we would record our initial investment, that should be 2016. Then we would record our share of 2016's income, which is 40% of the 150 and 8,000 of the 20,000 in dividends. And then we would proceed to record our share of the losses. we end up with a balance of 152. So when we have our $600,000 loss in 2019, we cannot record the whole $240,000 because it would bring the investment account to a negative amount. We can't do that. So all we can record is $152,000 of it, which brings our balance to zero. And the difference of this loss, you would keep track of, and if this investment ever turns around, you'd be able to take it against those losses. And this includes part one of Chapter 1 in what do we do when we buy another company stock as an investment.